Howdy, everybody. Welcome to Liberty Call. Today is Friday, February 28th, 2025. Hope you're having a fantastical day out there in the interwebs. It's a beautiful day here in Colorado. Temperatures in the 60s. The sun is out. There's no clouds. It feels amazing outside. So I had to run to town to get some mail. So I got to enjoy a nice, beautiful drive up to what is it? The Denver Tech Center, where my office or where I get my mail at. So again, hope everybody's having a fantastical day. Well, markets are holding steady as investors digest fresh inflation data, with the Dow up it's up more than 0.5% now. The S&P 500 slightly higher, and the NASDAQ was slipping at the time when I wrote this. The Fed's core PCE inflation index met expectations at 2.6%. Keeping rate cut speculation alive, NVIDIA continues to slide as AI demand concern grows, while Trump's confirmation of new tariffs on Canada, Mexico, and China are adding fresh volatility. Meanwhile, Bitcoin is taking a hit, briefly dropping below 80,000 and dragging crypto stocks down with it. So before we break everything down, I need you to help me out. If you could give me some thumbs up, a like, a share, subscribe, a follow, and press the notification bell. All righty. And there was also a big meeting with Trump and Zelenskyy at the White House. So we'll get into that in a little bit. But let's start out with the markets. Starting out with Dow Jones, it was up 1.39%. Things really jumped in the afternoon. Up 600 points, closed at 43,839. The S&P 500 up 1.51%, 88 points, closed at 5950. NASDAQ up 1.63%, 302 points, closed at 18,847. The VIX fell 7.71 today. It's at 1950. Canada up 1.06. Brazil down 1.41, and Mexico down 0.44. In Europe, Germany was down 0.25%. The UK up 0.61. France up 0.11. Netherlands down 0.43. Spain up 0.58. Italy up 0.08. Switzerland up 0.39, and Portugal down 0.64. Russian exchanges red again today. The MOEX down 1.12. RTSI down 1 3/4. And the overnight markets, most are all red. The Nikkei in Japan was down 2.9%. Australia down 1.16. New Zealand down 0.37. In China, the Shanghai was down 1.98. Shenzhen Component down 2.89%. China A50 down 1.32. DJ Shanghai down 2.06. Hang Seng down 3.28. And the Taiwan weighted down 1.49. So not a good showing across the markets in Asia. All righty. Well, let's take a look and see how the markets did for the week. Starting out with the Dow Jones, it's going to finish with this big rally here at the end of today, up 0.93% for the week. The S&P 500, where is it? There it's Friday. And it's going to finish down about 1.6%. The NASDAQ down 4.23%. Dow Transports, there we are. It's fairly flat, down 0.25%. And the Dow Utilities, there we are, going to finish down about 1.87%. So all the major indexes other than the Dow finished in the red for the week. Looks like NASDAQ was the worst. And if we hadn't had that nice rally here at the end of the day, we probably would have finished somewhere flat, because things really took off here in the last couple of hours. So anyways, all right. Well, that's our markets for the week. Let me put all my trend lines back on here before move that off the screen. All righty. Well, let's get to all the economic data that came out this week. Starting out with jobs, initial jobless claims came in at 242,000. Forecast was 222. Previous number was 220. Continuing claims came in better than forecast at 1.862 million. Forecast was 1.87. Previous number 1.867. The Conference Board's consumer confidence report came out this week. Came in at 98.3, under the 102.7 forecast. Previous number was a 105.3. U.S. new home sales came in at 657,000, forecast 679, previous was 734. New home sales month over month contracted at 10.5%. Previous number was an 8.1% growth. GDP for the first or second revision, or however it is, the second reading came in at 2.3%, right on the forecast. And then Q3 was 3.1%. Durable goods orders month over month grew at 3.1%, 2% forecast, and the previous number was 1.8% contraction. Pending home sales month over month contracted at 4.6%. Forecast was 0.9% contraction. Previous number was negative 4.1. Federal Reserve balance sheet came in at $6.766 trillion. Right below previous number was 6.782, so down by about 16 billion. And the PCE price index year over year grew at 2.5%, right on forecast. Previous number was a 2.6. And that's the PCE price. Oh, that's the year over year. And then the PCE price index for the month grew at 0.3, right on forecast. So that is everything there. Good stuff, I know. All right, let's get to the market recap. S&P 500 rebounds after stumbling following Trump and Zelenskyy clash in the Oval Office. And people are hot and bothered about that. It's funny to see, if you're on Team Red, you're like, woohoo, go Trump, go JD. You kicked him in the, what's. And if you're on Team Blue, you're like, oh, this is so embarrassing. And, this is no way to act in front of a world leader. It's like, who cares? I mean, seriously, Zelensky's just, scooping money up. And I mean, granted, he's in the position he's in because of our deep state, CIA, USAID, Victoria Nuland, and all those folks back in like 2014 basically put Zelenskyy in this position. And unfortunately, Trump's like, sorry, we're not helping you anymore. But anyways, all right. The S&P 500 rebounded on Friday after a brief dip following a tense meeting between Donald Trump and Ukrainian President Volodymyr Zelenskyy, which heightened geopolitical concerns. The benchmark index rose 0.7%, along gains in the NASDAQ Dow Jones Industrial Average as investors shrugged off initial worries. The meeting between Trump and Zelenskyy at the Oval Office turned contentious, with Trump criticizing Ukraine for not showing enough gratitude for U.S. support. He argued that Ukraine lacked leverage in its war with Russia and suggested that a rare earth minerals deal could help Kiev strengthen its position. Trump accused Zelenskyy of gambling with the lives of millions and being disrespectful to the U.S. Zelenskyy later took to social media, thanking America for its assistance and reaffirming Ukraine's commitment to peace. Again, all the problems we're dealing with now are, basically, our deep state and, like I said, our covert operations and stuff causing problems in, Ukraine a decade ago. And, is this is this an American person problem? Nope, not at all. I mean, Putin has, at least in my view of things from the people I listen to, like Scott, he's at the Libertarian Institute. Scott something, I forget his last name. Anyways, he's an expert when it comes to geopolitics in the Middle East and Eastern Europe and such like that. So, in my view, we should just get away out of this. I mean, the Ukrainians caused this problem with bombing the Donbass and all the problems that they created over the last decade. And then Putin has, at some point, just said, you know what? I mean, did he invade? Yes. In his mind, is he protecting Russians in Ukraine? Yes. So again, you got to look at it from an objective point of view, not good versus bad. All right, where was I? The latest personal consumption expenditures inflation data met expectations, rising 0.3% in January and easing slightly to 2.5% year over year. Core PCE inflation, excluding food and energy, declined from 2.9% in December to 2.6%. Signaling a cooling trend for now. However, consumer spending unexpectedly fell 0.2%, raising concerns about economic momentum. That is the one thing I've been telling everyone to watch. Pay attention to consumer spending. When it starts to tip over, then we'll start to really see an acceleration probably in unemployment and job losses and that sort of thing, because revenue slows down into businesses. They can't afford to keep people on the books as employed. The Federal Reserve, which paused interest rate cuts in January, continues to assess the impact of inflation and Trump's tariff policies before adjusting monetary policy. Dell and HP suffered steep losses, with Dell tumbling 7% on weaker AI server margins and HP dropping 9% after warning that China tariffs would drive up costs. Meanwhile, Bitcoin paired losses but remained down 17% for February as fading hopes for pro crypto policies and growing trade tensions weigh on speculative assets. Bitcoin will be fine. I see it as a buying opportunity, quite honestly, but not everybody does. All right. Next up, I got a data report here from First Trust, January personal income and consumption, put together by Andrew Opdyke. All right. A lesser known economic report on international trade signaled a potential drag on first quarter GDP growth, with a sharp rise in imports of industrial supplies causing a significant jump in the trade deficit. Even if the deficit narrows in February and March, trade could weigh heavily on GDP, potentially leading to a negative growth for the quarter. Meanwhile, despite a strong surge in personal income in January, up 0.9% for the month and 4.6% year over year, consumer spending remained weak, declining 0.2%. The income spike was largely driven by cost of living adjustments to Social Security benefits, which contributed to a 7.6% increase in government transfers to individuals. Government pay growth continues to outpace the private sector, with public sector wages rising 6.1% over the past year compared to 4.2% for private sector workers. Analysts remain skeptical about the sustainability of this trend, arguing that long-term economic stability depends on private sector earnings rather than government-driven growth. Consumer spending showed mixed results, with services spending rising 0.3% and up 6.4% year over year, while goods spending fell 1.2%, likely due to extreme weather conditions and wildfires in California. This decline is expected to reverse in February. On the inflation front, PCE prices increased 0.3% in January, with annual inflation holding at 2.5%, barely down from 2.6% a year ago, indicating little progress in the Fed's inflation fight. Core inflation, which excludes food and energy, also rose 0.3% for the month and 2.6% annually. With inflation still above target, the Fed has paused rate cuts, though potential government spending cuts in 2025 could shift the economic landscape. Additionally, pending home sales dropped 4.6% in January, following a 4.1% decline in December, signaling continued weakness in the housing market headed into February. All right. Well, that sounds optimistic. Alrighty. Last article here from Zero Hedge, Valuations Matter Eventually. It's written by Lance Roberts of realinvestmentadvice.com. The cyclically adjusted price earnings ratio, developed by Dr. Robert Shiller, is a widely referenced valuation metric used to gauge long-term market valuations. While some critics argue that high valuations have persisted without triggering a market crash, Lance Roberts of Real Investment Advice emphasizes that valuation metrics are not market timing tools, but strong predictors of long-term returns. Roberts highlights that during late-stage bull markets, valuation concerns are often dismissed, just as they were in the late 1990s and 2007. Investors believe the Federal Reserve will intervene to prevent market downturns, reinforcing complacency. However, while valuations alone do not cause market reversions, they act as a fuel for such corrections over time. High valuations typically indicate lower long-term returns. One major distortion in modern valuation metrics comes from corporate earnings manipulation. Since 2009, financial practices such as share buybacks, off-balance sheet accounting, and adjusted earnings measures have inflated reported earnings. This has created a mismatch between traditional valuation tools like the CAPE 10 ratio and the fast-moving financial environment. Roberts proposes an alternative measure, the CAPE 5 ratio, which smooths earnings over a shorter 5-year period, better reflecting today's dynamic markets. The CAPE 5 ratio has shown a high correlation with market movements, often leading to price changes rather than lagging them. Historically, when the CAPE 5 ratio begins to decline, it has signaled broader market downturns. Currently, the CAPE 5 deviation from its historical average is at extreme levels, comparable only to 1996 and 2021, both which preceded major market corrections. Roberts concludes that while CAPE 5 may offer a more responsive valuation measure, neither it nor the CAPE 10 should be used as market timing indicators. Instead, they serve as a warning that current high valuations suggest lower future market returns, making it unlikely that investors will see the strong gains of the past 15 years continue. Probably a good thing, or probably a good analysis there, simply because things typically revert back to the mean over a longer period of time, and when things are way above their average, tells you that you have a huge or much higher probability of coming in below average over a certain amount of time. So again, that everything comes back, reverts back to that mean. All right. Well, that's everything that I had to cover for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All your financial planning needs can be addressed there. So give me a call. I'd be happy to help. All right. Well, hope everyone out there has a wonderful weekend, and I'll talk to everyone again next time. Adios.